All right, so I have a question for you that I asked Ryan in one of these recordings. NASA calls you tomorrow, says, Eric, we're putting you on the next SpaceX trip to the International Space Station. Are you in or you out? Are you in or you out? You're in.
Yeah.
You didn't even blink.
No, definitely.
Awesome. We've had mixed results on this one.
Huh.
I think the submarine that got crushed like a soda can spooked Ryan. Joe Perry was also a hard no. I am an unequivocal yes.
Yeah, I mean, how often do you? I mean, actually, the submarine thing, I'd be more likely to go to space than the bottom of the ocean in a 4x4 tin can.
Yeah, they're not the same thing. Okay, well, I like your answer. Not risk adverse. Well,
I think I'm pretty risk ready when it comes to
risk ready. That's what I like. Yes. All right. Well, we're risk ready. Are you risk ready to record this podcast episode?
Yeah.
All right, let's do it. Welcome back to the Financial Insights. No, Casual Friday. Gosh, old habits die hard. The Casual Friday Financial Insights podcast. If you are watching on YouTube, I'd encourage you to subscribe. If you are listening on wherever you listen to podcasts, Spotify, Apple Podcasts. Eric, where do you listen to podcasts?
I listen to whatever Google does. I just ask it to play something and
it does.
It does it. I don't know where it comes from.
I like you're all in on the AI thing then. Well, wherever you listen to podcasts, you can subscribe there as well if you want to listen, if you want to watch. We post these on YouTube. We do these every 2 weeks, and we are joined today by Eric Simonians, CFP financial advisor here at Ford Financial Group. Eric, have you done one of these? We've done one of these before, haven't we?
Yeah, we've done a couple of these.
All right. Well,
in that case, dressed up. Back. You're always casual.
See, I feel like I'm the opposite. Last couple, I've been dress shirt. That's all right. It's Friday. We're going casual. Either way, it's I'm still reeling off of a Super Bowl loss, so it's hard to muster up the strength to throw on.
I'm afraid to say this, but I actually bet on the Chiefs. Not because I like them,
but because you thought they were going to win.
Yeah, and I just felt like, how could Taylor Swift lose the Super Bowl?
Well, you were right. So congratulations. I did not. I don't bet on my Niners. I feel like I jinxed them, but maybe I should have because they lost in overtime. And my 10-year-old was inconsolable. Like big sobs. It was a tough night in the Ullman household.
Yeah, I'm sure he wasn't alone.
Yeah. Now, I'm sure there is someone has figured out some alleged correlation between the market returns and who wins between the AFC and the NFC. We're not going to cover that today. But it's been a little bit of a roller coaster ride. Yesterday, we're recording this we're actually recording this before posting it on Friday. And so the markets are closed here on the 13th. And you can kind of, if you're watching here, you can kind of see this is orange is the Dow, purple is the NASDAQ, Russell 2000 is yellow, S&P is blue. If you look at this is a year-to-date chart. Russell was up 2% yesterday and like down 3 or 4 or 5% today.
I mean, it's the one that's moving the most. You know, it's all because it's also the biggest lagger. So eventually, that's what people are expecting, I think, to catch up.
Right, the biggest laggard over time. So we're expecting the Russell to catch up with the S&P. Is what you're saying?
Yeah,
boy, but it's the biggest roller coaster ride. Also, when you say it's just like. With these small caps.
I mean, small caps are the biggest beneficiary of no recession, and they get hit the most with recession. So it's, you got these 4 things that are kind of pushing this rally, and every time we get some news that cancels one out, we see a day like today.
Yeah, I mean, if we really shrink this down to 5 days, you can see like look at these gaps right here on the Russell, and I think you're right in that. It starts to look like rates are going to be cut, or it looks like inflation's under control. Small caps rally. Looks like rates aren't going to be cut and inflation's not under control, which is, we had the CPI report today.
Yeah.
But don't you think it's a bit of a waiting game? Like that inflation's going to find its way down, if not to 2%, like sub 3.
I mean, it's going down. It's just not as fast as everybody wants, but I don't think it's necessarily going down too slow. And I think it's just too much reading into one report after the other.
Sure. Maybe markets got a little bit ahead of themselves in November and December, too optimistic about inflation coming down and therefore rates coming down.
So. Yeah, you can see it. I mean, I think it's now with 65% chance of no cut in May.
Yeah.
So as those rate cuts get kicked down, the markets kind of react.
Yep.
Negatively.
Interesting though, because if we're going to have some volatility, and if we're going to, if we're having volatility and we want to try and take advantage of that, we'll start with your chart for today, which is, oops, I meant to share this. Stand by. Talking about money markets and what's going on with money markets. Well, they're kind of everybody's favorite right now. I put more money in money markets for clients at their request in the last year than I have in the last 16 years combined.
I mean, I think it was maybe middle of last year. I got my bank statement and I saw this line entry in there. It said interest. I was like, what is that? It's been a while since you get these kind of returns.
Yeah, I think two things are at play. And so we'll see here. So I think this probably caught your eye because we've got more money in money market funds than we have since like 1990. I don't know if this adjusts for inflation or what, but this is showing the average yield on money market and the total assets. So this is the average yield of the 100 biggest money market funds, 5.2% last August, highest in 16 years. And 16 trillion in money markets. That's a lot of money on the side.
6 trillion.
I'm sorry, did I say 16? I meant 6 trillion.
Yeah, that's a lot.
A lot of that coming from the savings accounts, right? Because you're still getting 2 nickels at your bank on your savings.
Yeah, I'm not seeing at least the flows of people kind of running and hiding from their investments, but it's more, pulling money out of the bank under the mattress, so to say, to get some returns.
Yep. A lot of dry powder, as they say, right? And if we kind of go through here, you can kind of see just on the dynamics. This is from Visual Capitalist, which we will post in the show notes if you want to take a look at this page for yourself. But I
thought this was a really insightful chart.
Yeah, go. Well, why don't you walk through it for those who are listening and not watching?
So, you're seeing like you said, with highest rate in 16 something years. And if you go back 16 years, that was, right before 2008 when we started seeing the rate cuts.
Yeah.
And you can just see this line. It's, what do you call it? It's just a big, like a big canyon. It's up, goes down, stays low for,
a decade.
Yeah, almost 10 years. And then COVID, back to zero. And now we're at the peak. So, I think everyone agrees that interest rates aren't going any higher. So
no, and the Fed chair said it as much on November 1st, and then he went on 60 Minutes. I don't know if you're a 60 Minutes guy, but it had the ring of January 2019, right? When rates were going up in 2018, they peaked in 2019, and Powell said that interest rate increases weren't on autopilot anymore. He went on 60 Minutes again first week of January now this year, saying that rate cuts were ahead. It was just a matter of time. I don't know if markets are going to rip the way they did in 2019, but I think what you've got is, the thing about money market funds is that these rates are variable or floating.
Yeah.
And so as rates come down, this is going to become less attractive.
Right now it's real attractive, right? Especially after, the roller coaster rides we've had in the last 2 years. So it's, but when that rate goes down to 3, 2, or even lower, it's really not attractive. And you have to look at the opportunity costs of keeping the money in there.
Sure. And I know some clients who would say, 5% a year, sign me up. I'll do it. Risk-free, not having to worry. They're not going into space like you are. They're like risk averse, wanting to get this 5%. So I think you're left with a couple options here. One of those options is to kind of, I guess 3 options. You stick around in the money market and just
wait it out, watch it dwindle.
Yeah, and you get less and deal with it later. Maybe lock it in, Treasury, CD. Have you had anybody doing that?
Yeah, toward the end of last year, was a pretty good time to lock those in at the 5%. But again, you're looking maybe 2 years out the most.
At the most, right?
Yeah.
I think one of the things that has the appeal of money market funds is that it's more north of 5% and it's liquid. You want your money out tomorrow, you get it out tomorrow without any issues. It's not insured, of course. And then the third option is to say, hey, yields are down. I need to start. I mean, when markets were up in 21, 22, wasn't it called the Tina trade?
Oh, yeah.
There is no alternative. You couldn't get returns anywhere else. And I think as yields start to go down, we're going to find that some of this money is going to find its way probably in the market. Yeah, a lot of dry powder. The chart that I chose is allocation performance over time.
This is a good one.
Yeah, I like it too. This is kind of a newer one. It shows returns. So this is starting from this one starts from January 08, right? And
what a lovely time that was.
Yeah, well, I mean, it was the beginning of the end for a moment there. And it shows markets bottoming 2009, and then how long it took to get to break even in each of these portfolios. So we're looking, blue line's 100% stock, yellow line is 60-40, red line is 40-60. That's 40% stock, 60% bonds, and then 100% bonds in there. Not surprisingly, not listed here is that bonds broke even pretty quickly. Bonds weren't down all that much in 08.
The bonds rallied fast, and
no doubt.
It's kind of what you might expect to see eventually during this cycle, is to get a real boost in the longer bonds. But it's got a cap, so to say, right?
Yep. Yeah. And bonds, I mean, when rates are dropping from 5% to 0, and that's going to be a tailwind for bonds. Now, don't get me wrong, bonds were negative in 08, but they bounced back really quickly.
Yeah.
And they weren't down as much in 08, even as they were in 2022, right?
Yeah.
The ag was down 13 or something percent in 2022, where it was down only 7-ish, I think, if my memory serves, for 2008. In February 2010, a 40-60 stock to bond portfolio broke even first. And then about a year and a half later, 60-40 broke even in 2012 or October 2011. So that's how long it took to bounce back. November 2012, all stock breaks even. And then in 2016, an all stock portfolio. So 8 years essentially later, an all stock portfolio finally started to move higher, and it is now doing laps around everything else.
But it really shows you, like, where the smooth ride is. Obviously, if you have unlimited time, I'm going to tell someone to go 100% stock, right?
Sure.
But if you're, want something smoother, it really shows the benefit of being diversified.
Yeah, and you can have a mixture of stocks and bonds even in these rough conditions, because even though market bottomed in March of 2009, like, it was still touch and go. 2009, 2010, and lots of talk about double dip recessions.
Yeah.
The Greece credit thing and what was going on in Europe, and Germany loaning money to Greece. I mean, there was a lot of our U.S. credit was downgraded. I mean, it wasn't a smooth time in 2010, 11, 12, right? But you were still able over that period, it actually having a mixed portfolio outperformed. So you didn't need to be full risk on to be able to generate solid returns, which, if we're taking your money market chart and combining with this, it would suggest maybe you can come out of money market, but still have a conservative portfolio so you can make a little bit more.
Definitely get some enhanced returns.
Yeah.
The money market, which is going to start going, it's just going to stop paying, it's as the rates go down. So,
right.
You could take advantage with the, not as much risk as you would think you'd need.
Sure. Which means, I mean, of course, it depends on a person's situation, but you have a correction this year and rates start to go down. Maybe it's time to
got that dry powder, use it, right?
Yeah, exactly right. Get off the sidelines, go into a mixture of bonds and equities. This changes for everybody though, right? If you're in your late 70s, early 80s, the calculation is going to be much different than if you're late 30s, early 40s.
Absolutely.
Yeah, if you have time, obviously you can take one look at this and see, okay, well, stocks is the way to go. I will say there's damn lies in statistics, right? We're taking a measure from the beginning of the great financial crisis clear to these last few years with COVID and printing money. And I mean, look at the roller coaster ride that stocks have been on essentially since COVID. It's been pretty wild.
Yeah. But the trajectory's still up.
Yeah. And I think if you went to somebody and said, hey, over this period of time, what is it? We're calling it not quite 18 years. Would you be down with a 222% return? I think people would say yes.
Yeah, definitely.
I think I might say yes, even. Good gravy. So bonds aren't dead yet. A mixed portfolio has some value, even though you're not maximizing, you're still doing better.
I think smoothing it out, right?
Exactly right. I'll be curious to see. You want to give us a hot take on when the Fed's going to cut rates?
I want to say I want them to do it in May, but I think they're going to do it in probably, is it June? Yeah.
Yeah, I think June. Well, here, I'm going to pull up. We don't usually go on the fly here, but I'm going to do it anyway. Here we go. I'm going to share my screen here.
Yeah, I think it's June.
All right. Nope. Here we go. Fed chart book. Here are the futures. Let's take a look. So you've got June or July. The likelihood of an implied rate cut growing by the month, where you get to late December, and that's pricing in a Fed fund rate of 4.21. That's almost 1.5% rate cut.
Yeah. When is this? Is this current?
This is current. Yeah. Okay. So still, I don't even know why there's even a possibility here of March, because we can all agree that's not
March
happening.
Is definitely not, and I don't think. I mean, they could still do it in May. It's only one report.
Yeah,
but I don't know. My gut says the Fed's going to be slow. Like they're usually not the fastest to make a change.
So. I was gonna say, are they ever early? They're like never early.
In the 70s, maybe they did stuff not so well, but they don't want to relive that. So they want to be real sure, I think, before they start dropping rates.
Sure. An interesting take I heard on this was, they might cut rates 0.5%, so they're not over tightening. Get to that Fed fund target rate of like 5% and try and leave it there until they have to really, really cut. And the reason why those Fed futures have big rate cuts down the road is because it's either we have a soft landing and they just cut rates a little bit to try not to over tighten, or we have a full blown recession and they're slashing rates in between meetings and cutting it by 0.5% or 0.75%.
So this is just the average of time. They're not saying it's going to cut 25 every meeting.
Exactly right. So you get kind of this barbell effect where it's either going to be a little or it's going to be a ton. And nobody really knows for sure. I don't think the Fed knows either.
I definitely think the Fed doesn't know.
There you go. Yeah. Well, we get to wait and see. Well then, we'll do this again in June, and I'm going to hold you to your prediction.
All right, let's see it.
Not that anything's at stake here. All right. Well, we snuck in an extra chart, so we went over money market, which I'll link to that visual capital. I'll link to in the show notes. We talked about the asset allocation performance, and of course, just for fun extra, we threw in the Fed futures implied rates chart. This is the part of the program, Eric, where we talk about what's on your mind. What are you reading? What are you watching? What are you thinking about?
Well, I guess I've actually been reading a lot of Roald Dahl books lately.
Oh, you and me both.
Yeah,
because of Hunter's school.
Yeah, and he has to read some chapter books, and I've actually, I didn't read them obviously since I was his age.
Sure,
but they're actually they're really entertaining and amusing. But I actually also find them they really do hit some serious kind of adult topics.
Yes.
And they do it in a good way. There's some, just read the BFG. That guy's got some PTSD.
Yeah. So we read, my son read BFG. Have you watched the movie yet?
No, I haven't seen the movie.
Yeah.
Is it good?
Yeah, it's good. It's good. We also just read, the kids read, and then we watched Matilda.
Oh yeah, we just finished that one too.
Yeah. So
They,
you know, we're moving on the same lines.
yeah, I mean the topics they really teach the kids in a fun way, and I don't know if I even noticed this when I was a kid,
For
but there's
sure.
some good stuff like like perseverance and
Yep.
education being good and overcoming adversity and
Independence,
yeah,
streak there. Yep.
I really
Absolutely.
so I think they're good books for kids.
Nice. Well, good. Yeah. That's funny that you're doing that. We are too. James and the Giant Peach hasn't come, which is the one that I always think of Roald Dahl with. But maybe that's what's next in our house. So we'll see what gets assigned.
I didn't even know, and this is kind of embarrassing, that he wrote Charlie and the Chocolate Factory. I didn't even know that.
Oh, is that right?
Yeah, and then it was the first one we read together, and I was like, oh,
Well, I'm
I
gonna
didn't
go on
know.
I'm gonna go on a limb and say you probably knew this, but have since forgotten.
I'll take that.
Yeah. We're good. Well, I see that's not what is on my mind is my deep sorrow. The Super Bowl was just played. The 49ers just lost, and we're a 49er household. My kid is deeply sorrowful that the Niners lost. Henry specifically.
It's probably the first time he didn't know his heroes could lose,
kind of, and I don't think he wasn't old enough to realize they weren't making the Super Bowl in the last couple of years, but he was in the brainwashing is fully set in. But for me, I am trying to get caught up. I had a New Year's goal of reading about a book a month, essentially 12 books this year,
how's
and
that going?
I am behind on said goal. I'm halfway through 2 different books, and what I need to do is
How do you do that?
slow down. I don't know. I kind of get interested in one, and I read it, and then something else piques my interest, so I start reading that too, and so I bounce back and forth.
I'm all
It's a
about
problem.
fail fast. If you're moving to a new book, just dump the other book, move on.
No, it's almost like I'm committed now. I'm going to finish both of these books by the end of this month, and so that way I can be back on my goal of getting both of these done. But
You have the extra day this month, so got that.
Yeah, right. I'm going to use the 29th to do it. That's a great idea. Nice. Well, cool. Well, I'll tell you what, Eric. Thanks for jumping on this one. I'm glad that we could to have you on. We'll have to have you back. We'll do more. Yeah. So until the next one, keep watching the Fed. We'll see if your predictions come true.
Good luck with the books.
Yeah, thanks.